Good morning and welcome to Wall Street Confidential. This is George Moriarty, executive editor of TheStreet.com, here with Jim Cramer. How you doing this morning, Jim?
Good to see you.
Good to see you.
Yep.
So yesterday, Fed stands pat.
Right.
People had different impressions on what that means. Doug Cass said the Fed's telling people it's bad.
Right.
You came out and said, hey, Fed says things are okay, nothing too good, nothing too bad.
I was wrong when I said that the Fed would cut rates in May. I'm going to get that off the table for those who say, hey, he never admits that he's wrong. Happy to admit it. What I misjudged is that the Fed is not looking at the data correctly. I was afraid of this. They're not looking at rest of world business as being what's driving American companies. They haven't been on the conference calls clearly. They are also concerned with the two most intractable forms of inflation. Mineral inflation, which is being driven almost entirely by China,
right,
and agricultural inflation, which is being driven by our decision to be able to go for renewable fuels, even as it is uneconomic.
As you've discussed a little bit on One Step Ahead with
Yeah,
Keith Lieberthal,
and it's great disappointment to me. Had the Fed looked at the conference calls of just yesterday with Toll Brothers or with some of the retailers, I think they would have to reach a different conclusion. I am not turning on this market, though, because they did add a line which says they understand first quarter weakness. That's the beginning. This Fed is not responsive. It's just not responsive. And I think Bernanke is a fine man, but he's not responsive to what I see going on.
There are people out there who are saying, we're still going to get a rate cut. It's just prolonged.
Well,
is that still in the scenario, or is it going to be a worst cut scenario where the Fed waits too long for an explosion that hurts it more?
George, I now believe that the Fed will wait till negative GDP. But we'll get it. I mean, the cavalry's coming in the form of an incredibly weak economy.
Yeah.
We saw that with some of the retail sales. I also want to emphasize this, that this was just a big bad event in the end. That there were enough people who felt that nothing would happen, that as soon as it was over, they came in and bought.
Right.
That's very telling, because what that says is that the pent-up demand is only willing to rest for a day or two before it comes right back to come in and buy in the MasterCards again, which is really, MasterCard's worth $200. I've been saying that. They come in, they immediately buy the Goldman Sachs, which I own for ActionAlertsPlus.com. Nothing's changed. It's a good moment.
Real quick, while we wind up, obviously these retailers coming out. Doug Cass had a great statistic. I just want your quick reaction. April reported 6 beats, 0 in line, 27 worse than expected from the retailer same stores. March, this comes after March, where we had 26 beats, 3 in line, and 4 worse.
All right.
Net, where are we?
It's just a false pretext that he's doing. We deconstruct what he's saying. We presume that worse than expected is looking for a bench line and then coming underneath. No, these were as expected, which were bad. It's quite different. We only care about estimates and them being beaten or being equaled or being below. They equaled the estimates, which is why the group must be bought, because the stocks are going down as if they were going to be worse than the estimates. They're not. Bring them in.
There you go. That's Wall Street Confidential. I'm George Moriarty. This is Jim Cramer. Stay tuned for more from TheStreet.com TV.